Hello, everyone, and thank you very much for joining us today. My name is Ameya Upadhyay, and I work at Flourish Ventures. We're a venture capital fund with a purpose, and that purpose is improving financial health of individuals and small businesses. We do that by backing entrepreneurs who share that ambition. We're a global firm, and I focus on our work in Africa. Well, today we are going to be talking about embedded finance. So let's just define that term briefly. Finance is becoming second nature. It is increasingly a part of products and services we use every day to make our lives more convenient and fun. Today, more than 1 billion people in China use a chat application, WeChat, to make payments to friends and family. Gig worker platforms like ride-hailing platforms or food delivery platforms are offering financial services to their gig workers. And digital platforms that are helping mom and pop stores or freelancers or smallholder farmers improve their income are also adding finance to the mix. And so this idea of adding finance to non-financial services is what we call embedded finance. COVID, with its lockdowns, has only accelerated the trend towards embedded finance. As we've been forced to stay at home and more of our lives have moved to the digital world, these digital platforms that we were talking about are becoming more popular, and they're becoming more prominent suppliers of financial services. So today, I'm incredibly excited to have the CEOs of 3 such digital platforms join me. And we are going to talk about what embedded finance means for their core business, and most importantly, what it means for their customers. So with that, let me welcome Afif from ShopUp, who's joining us from Dhaka, Bangladesh. Bilal from Maxup, who's joining us from Cairo, Egypt, and Jimmy from Propel, who's joining us from New York City, USA. Thank you very much to the panelists. Thank you for taking out the time to do this. It'll be a fun conversation. Right, let's start with talking about the core business and the core platform folks. And let's follow the sun. So Afif, my first question is to you. Who's ShopUp's customer? And what problem are you solving for them, and how?
Yeah, thanks a lot, Ameya. First of all, it's a pleasure for me to be here amongst such exciting founders. So very briefly, ShopUp is a full stack B2B commerce platform for small neighborhood mom and pop shops. So in Bangladesh, we have 4.5 million of such neighborhood shops, and they actually cover 98% of the entire country's retail. So they are actually one of the most important economic groups for the entire country. But if you look at the trend of the last 20, 30 years, majority of them has not grown. So in fact, their growth rate is actually lower than the inflation rate that we actually are having here. So which basically means, in essence, they are actually degrowing. Right? Their purchasing power, income, everything is actually degrowing if you consider that. So we try to understand why that is. So we primarily identified 3 core segments, and that's basically what we solve. So number 1 is basically their supply. So all of these small shops, they have to manage a very complex supply. So even a very small shop will have to manage like 40 different suppliers. So we aggregate all of these, make it very simple for the neighborhood shop, and they can procure anything and we deliver within 24 hours. The second thing we realized is the logistics. So all of these 4.5 million shops are spread throughout the country. And in many cases, they're in very remote areas. So reaching to them is very costly. And this logistics cost quite often goes as a burden to the retailer. So their income basically gets narrowed down, and their ability to actually grow their business basically significantly drops. And the last and one of the most important one is access to capital. So only 10% of these neighborhood mom and pop shops will have access to formal finance from banks in the local market. So it significantly blocks their ability to grow at the rate they would have been otherwise. So solving these 3 basically is what we felt like is the main solution to make sure these people can grow. And this is what we call the iron triangle of commerce. So that's basically what we are building. The full stack B2B commerce platform for neighborhood mom shops in Bangladesh.
The iron triangle, I like it. So Afif, just briefly paint a picture of, just help us set the context here. What's the level of digitization in Bangladesh? How mature is the VC ecosystem? Just help us place ShopUp on the map.
Yeah, I think Bangladesh has started to become one of the most exciting. So we would call it, this is probably the most exciting emerging markets to invest right now. So in the last 5 years or so, the consumption has almost tripled. So the And in fact, Bangladesh right now has the fifth largest mobile internet user base in Asia. In fact, ninth largest globally. It has one of the largest population in the world as well. So 2.5% of the entire world's population lives in this small block of land, the size of which is equal to the New York State. So it's in a very exciting time to invest in Bangladesh. The growth has just started to grow significantly. A big chunk of the population has just gotten access to smartphones and internet. So we believe right now is the right moment to build a tech-first product in this country.
And Afif, how does ShopUp make money?
So all these three components I made, so we have a margin or take rate in all three. So when we do basically one transaction with a retailer, so based on whatever, how many of these three the retailer is taking, so we get a take rate on that. So that basically is how we make.
And Afif, when we were talking, you had a number of a measure of by how much you're reducing costs for these mom and pop stores and corner stores. What's that?
Yeah, so we basically try to understand the quantum of the extreme distribution efficiency problem that exists around these neighborhood mom and shops or pop shops, and we try to calculate what's the cost of everyone in the ecosystem to distribute products, loans, financing products, all of these to these small shops. And that amounts to 17% of their entire sales, like monthly sales of the small neighborhood shops. Now, if you do everything under one platform, as a full stack platform, you can do it within 2.5% of that cost. So that 17% becomes basically 2.5%. So that's the kind of delta you can gain if you can build a full stack like Iron Triangle platform. So we are going for that kind of value addition to the retailer. So looking forward to that.
It's incredible. Bilal, I'm going to ask you the same question. Who is Maxup's customer, and what value are you driving in their day-to-day lives?
Sure. So similar to what Afif is doing and ShopUp is doing, we're pretty much solving the same problem. This problem is in Bangladesh, it's in India, it's in most of the emerging markets that are highly dependent on independent mom and pop shops, right? In Egypt, the number is not 98, but it's still 90%, so it's significant enough. And these are my customers. So my customers are these small mom and pop shops. Mainly, we focused on the most underserved areas because this is where we add the most value, where the merchants are smaller, and at the same time, it is harder for the FMCGs to reach these specific neighborhoods. So just to sum it up, my customers are the most underserved merchants in the outskirts of Egypt.
And Bilal, give us a sense of what the status quo is. How are these merchants sourcing their inventory before MaxAB entered the picture, and how that changes now? Like, what's the before and after?
Sure. So the picture was very fragmented. There is 400,000 merchants across Egypt, with 100,000 of them in Greater Cairo alone. And they get their products or their inventory from up to 5 layers in the supply chain. When an FMCG comes to the market in the local market, or a local company is built, they build their distribution arm. This distribution arm will, in essence, serve the big enough merchants and will neglect the smaller ones, or they will pass it along to a sub-distributor to serve these ones. And this sub-distributor will then further pass it along to other layers of wholesalers, whether what we call a major wholesaler, and then a wholesaler, and then a sub-wholesalers. So this is how fragmented it is. Everybody in this value chain has something to add. These sub-wholesalers are always closest to the market. So the guy can just walk in and get this inventory, but at the same time, he will get it at a very high price. The major wholesalers' main role is actually aggregation, which what we do, but the quality of service is very bad, and the retailer will have to get a car and go to the wholesale market to buy this inventory. And these small wholesalers will probably get neglected by the distributors as well, because it just doesn't make economic sense for the distributor to pass by them. And when we came into the market, that's exactly what we've changed. We acted as a one-stop shop that delivers this inventory to the most underserved merchants. We carry a very wide range of inventory, and we deliver in 24 hours with a very high delivery success rate. And that, in essence, changed a lot in the terms of how the retailers think about their business and about their cash flow specifically.
Okay, and retailers can now order their inventory on an application as opposed to just waiting for the manufacturers to show up at their doors, correct?
Yes, so the entire supply chain have changed since we came into the market from a push-driven supply chain to a pull-driven supply chain. So our entire supply chain is triggered by a retailer ordering through our platform, and this point of data triggers everything else in our supply chain, from the data we use to build up our inventory, to how we price, to which SKUs do we consider to adding, and which ones do we consider to delist. Everything revolves around the data, the 124 different data points that we collect in every single order from our merchants.
Understood. Thank you, Bilal. Jimmy, moving on to you. Who's Propel? You know the question by now. Who's Propel's customer, and what problem are you solving for them, and how?
Hey, Ameya, thank you so much for having me here. It's an honor to be on this panel with you all. Propel's main business is serving people who are low income in the United States who use safety net services like the food stamp program. So in the United States, there's a food assistance program where people who make under a certain amount of income qualify for a government, a benefit that the government provides that is intended to help people pay for food. There are about 42 million Americans who receive this benefit each month. It's about 1 in 8 people throughout the country. And if you are one of those 42 million Americans, you receive your benefits on an EBT card. It is a debit card that's issued by the state. And when we talked to people who have EBT cards, we found a funny quirk. And that quirk is that people check their balance by calling a 1-800 number. And so I naively asked at the start of the company, why isn't there a mobile banking app for this financial product? It looks like a debit card or a credit card you get from any financial institution. Why isn't there a mobile banking or a digital way to access your funds? And couldn't find a very good answer. And so that's what we built. We built the country's first mobile banking app focused on people who receive EBT benefits or SNAP benefits. It is a free app that people who use can, instead of calling that 1-800 number, can instead use a kind of modern mobile banking app that allows them to see their transaction history, see their balance, to access a variety of tools to set a budget, and also to find ways to save money and make more money. So Propel's customer is actually different than the core consumer of the app, since the app itself is free. The customers that we serve at Propel are the organizations that use Propel as a marketing channel to reach our users with ways to save money or make more, or to make more income. So whether that's employers who are looking to hire our users, or utilities companies that are looking to help our users pay their utilities bills, or telecom companies that are looking to help our users pay on their cell phone bills or home internet bills, or grocery stores, those are really the customers who fund our platform.
Understood. And Jimmy, Propel's product is designed with one specific consumer segment in mind. Can you talk a bit more about that and how that's informed your design choices?
Yeah, Propel's core user is a single mom in the United States. So 85% of our users are women, 87% have a child under the age of 18 at home, and the majority are living in cities. That is not too dissimilar from the population that uses safety net programs like the food stamp program in the United States. And that choice of who we serve, that understanding of the consumer, is really fundamental to how we decide what features to build, what to prioritize, how to brand our product, and so on. It's really that we believe there's an opportunity to build a trusted and deep relationship to this consumer by meeting her where she is, by speaking her language, by trying to address her daily concerns.
Understood. And even though the monetization happens through linking this customer segment with suppliers of different services to them, and that comes through as an advertising, you serve as an advertisement channel, it's different from an advertising platform in several significant ways. Can you say a bit more about that? How Propel is not your typical advertising internet platform?
Yeah, we're not an open advertising platform in that every piece of content inside of the app is manually sourced and designed by our team. We only have about 40 customers on the platform at any one time because we actually do really want to limit the content to content that actually helps our users to either make money or save money. And we believe that that's the flywheel that we can create here is that if our users don't see the content as ads, but instead see it as a feature, see it as a reason to use our app and to frequent our software instead of some other one, that's actually going to be really beneficial to the ecosystem and to what we're trying to build in the long term, which is really a trusted financial platform to help people who are low income in the United States to improve their financial health.
Awesome, makes sense. Jimmy, let's turn gears a bit here and talk about what you've learned from your consumers. You have more than 4 million people using the Propel app. Give us a few lessons that have come through and how that's affected your business.
Yeah, one of the themes that we have come back to time and again is that one of the key day-to-day themes for low-income Americans using safety net services like the food stamp program is the need to reduce uncertainty. That is sort of the role that our app, we realize the emotional role that our app plays in people's lives is that as it stands, it's hard to know when your next deposit's going to come, when, like what you're going to use to buy dinner for your family, whether you can buy dinner next week and the week after. And so trying to reduce uncertainty for our users has become a core value proposition and a core way that we think about building and designing the app in the future. We've taken that to not just build sort of small features around setting a budget, helping people predict what's going to happen, but it's also played a big role in helping us understand sort of what the next step for our platform is going to be. And that's, I think, another big thing that we've learned at Propel, that the government benefits that someone uses, something like the food stamps program or the EBT card, that's only a slice of someone's financial life. The reality is if we want to help people to make it through the month, that's going to require us to help our users navigate not just their public benefits, but also private sector sources of financial services, whether it's their income from work or whether it's their cash payments from something else. That we really want to be the platform that helps people to manage all of those different types of things. And so that's sort of where we are headed as a platform, is picking off more and more parts of someone's financial life to be able to operate under the same platform.
Okay. And did COVID change affect the business significantly? How did you adapt? What happened to you? How did the customer needs change and how did you adapt?
Yeah, in the United States, unfortunately, lots of people had a lot of financial challenges as a result of the pandemic. That resulted in a lot of people losing jobs, and a lot of people who were already financially vulnerable were the ones who sort of saw the greatest and earliest implications. And in the first few months of the pandemic back in 2020, about 80% of our users who were employed had lost their jobs or cut their hours. And so that has huge implications on, how are you going to pay rent? How are you going to pay for bills? Can you buy even household goods like toilet paper and soap and hand sanitizer? We recognized that for low-income Americans, there wasn't going to be just a silver bullet. There was no single answer. There were a lot of things that the government did around stimulus payments and the unemployment program and so on, but that those things were not going to be sufficient in and of themselves. One of the things that we tried to do to contribute was we worked with a handful of partners on a thing called Project 100, which was a way to send charitable cash payments directly to people who are using our platform. The idea is that everyone who uses the Fresh EBT app is verified as being in financial need because they're using a safety net platform. And as a result, we can send them cash. If we can find charitable organizations or organizations that have capital to fund and want to distribute that just directly to individuals that are in financial need, that we could become sort of a conduit for that transaction. We could do that very quickly. We could do that without taking any transaction fees on top of it. And we could send that directly to individuals. And so we were able to do that last year. We ended up sending about $140 million through that program, thanks to the generosity of a lot of funders, including Flourish Ventures, actually, and just other organizations who saw the benefit of direct cash transfers in a time of extreme financial need.
That's incredible, Jimmy. Thank you very much. Bilal, I'm curious to hear your lessons. I mean, MaxUp is by and far the leader in helping mom and pop stores and corner stores digitize themselves. And so now you serve tens of thousands of merchants. What have you learned about their behavior and how has that informed product evolution at Maxup?
So the first thing we've learned in this business is what's the most important thing for the merchant. Problem number one is actually finding the inventory in store, right? Problem number two is actually price. Problem number three is actually efficient delivery or a reliable service. This is from an inventory perspective. But on the other side, if you ask the merchant, what do you really want? He won't ask for any of this. He will ask to pay in credit. And this is where our credit solution comes in play, right? Because this is what the retailers want the most and what they need the most to improve their business. One of the very unfortunate findings that we came across is that most of our retailers don't actually make money. It's just that they don't know they're not making money because it's very hard for them to calculate their cash flow and their profits because it's a one-man show that is buying hundreds, if not thousands, of SKUs and running this entire business is on his own. He is the supply chain department, he is the procurement department, and he is the sales department. So you cannot ask of a human being to do all that on his own without the help of technology. Now that they did not have some of the basics, such as a point of sale system or an ERP system, most of them actually still don't have that now. We're trying to be as effective as possible in giving them stocking decisions and eventually pricing decisions as well and recommendations on what to buy with what, so that we act as some sort of a virtual ERP to further enhance their business. Plus, definitely including our fintech product, which has two main elements to it. One of them is offering credit. The other is availing e-money kind of service so that the merchants can generate more revenue through availing bill payment, any sort of bill payment service to their customers that still prefer to pay on cash and don't have credit cards or any sort of access to online payments.
Bilal, I'm going to come back to this point around credit and e-wallets and e-payments in just a moment, because that's going to be the core for the next part. But quickly moving to you, Afif, ShopUp's business changed dramatically during the first lockdown, and now, unfortunately, the subcontinent, including Bangladesh, is facing a second lockdown. What have been your reflections on how the product has changed and how the customer needs have changed and how ShopUp has adapted and evolved in COVID?
Yeah, I think so. A couple of years back, the platform was primarily geared towards social sellers. So essentially, individuals were trying to shop on Facebook and start gaining customers on Facebook. And interestingly, in Bangladesh, majority of online commerce is still social commerce. So e-commerce is still getting that kind of up. So that was the product we used back. Once COVID hit, what we saw is, so just before COVID, so we always had this ambition that we go to offline for these neighborhood mom-and-pop shops. But we first wanted to create our own infrastructure based on the online sellers. Then we wanted to move to offline.
I'm sorry to interrupt you, but just for our listeners, you're saying that in Bangladesh, people are not buying from Amazon or these big traditional e-commerce websites. They're buying from Facebook and they're buying from other social platforms. And the folks who are selling there, those are the individuals you're calling social sellers. Yeah? Absolutely.
So even before, just before COVID, 4 out of 5 online orders were actually on Facebook sellers. So these centralized sellers like Alibaba and others, they were only doing like 1 out of 5 orders. So that's the kind of the industry context that was before that. Now, once COVID hit, what we saw is the neighborhood mom and pop shops became a very important channel for essential products. So they were basically making sure throughout the lockdown, like all the communities have access to essential products. At the same time, their supply chain being very fragmented was very badly hurt. So as I was mentioning before, like one small neighborhood mom and pop shop we probably have to maintain like 40 different supply contractors. And all of these are like small distributors or small wholesalers who are also badly hit. So at that point, it basically became very important to have a reliable source from where they can actually at least stock up their shops with essential products. So the underlying category mix changed dramatically. Before that, majority was apparel on a platform. Because online, like apparel is a dominant category in Bangladesh. But very quickly, within a matter of like 1 or 2 quarters, the category mix shifted the other way around. So at that point, we doubled down on staples. We basically added categories like rice, potato, oil, things that basically people need like day in, day out, and gradually also fresh. And we have seen good growth on that year. So, for example, in the last 1 year or so, the number of actively ordering retail has gone up by around 18 times. And what we are also seeing is self-service orders are also going up because people now prefer to place order at their own convenience and not just wait for someone to come to the shop and then place an order. So that has been a very major change, which meant we had to change the supply chain very dramatically throughout the long term. So like luckily we could execute that so far. So forward, towards the next couple of months.
Yeah. Bilal, let's come back to this issue that you brought up. I want to pivot to the embedded finance question. And you were saying that one of the biggest needs that you've identified for retailers in Egypt is credit, right? So talk a bit more about what exactly are these two products of the finance products, and even more if you're integrating them onto the platform. What are these finance products and why you are best placed to offer them, as opposed to, say, some microfinance bank or institution for credit? And, there are these payment companies in Egypt, Fawry, for example. Why shouldn't they offer it to your customer? Why are you best placed to do it?
Yeah. So in essence, any B2B e-commerce business is not in the commerce business as much as it is in the payments business. Anyways, it is still a big part of any supply chain. Any supply chain consists of inventory moving down the supply chain and cash moving the other side of the supply chain. So in essence, we are a payments company, whether we like it or no. We move exactly as much cash as we move inventory, right? And that made it a normal evolution for us to go after this piece. The way we thought about it, about the fintech product, is how do we use finance to improve the life of the merchant, right? It's not just to generate an extra buck on charging interest rate, right? Because this is very short-sighted, and if you do it this way, he will work with me now. A year down the line, he won't grow his business and he will default on these loans. So we're building our financing product into 2 sections, as I mentioned earlier. The financing section is to offer, is to avail actually a platform from the supply side for all the institutes that want to lend these merchants, to lend them through our platform. And we agree with them on some sort of a loan product for these merchants that actually fits their working capital needs. And so far, it's only been trade financing, or just financing these purchase orders for a tenure as short as 1 week and as long as 4 weeks. And that helps them stock way more properly, so that when customers walk into their store, they have all the options available. They minimize the number of shipments they have to take from Maxup or from anybody else. And that's every minute they save. On average, the merchant will spend 20-25 minutes receiving a shipment, regardless the size of the shipment, right? So if you can have amount of shipments, that's more time for him to spend on buying. And you cannot do that because unless you have enough cash to place bigger orders. And from our perspective, having bigger orders goes back and improves our entire operational cost, which we then can pass some of these savings to these merchants as well. The other element to our fintech product, which is the e-money, we wanted to build it to actually improve or increase the revenue per square foot for the merchant. We give him a POS from which he can download the app, and you do all types of top-up services and bill payment services so that he can get more revenue. And actually, it's coupled by our financing product because we're offering him an overdraft kind of solution. So he doesn't need to wait like what's traditional in the market for the agent of the bill payment companies to pass by him and give him the cash for him to charge his wallet. We actually give him an overdraft after we credit score him based on our understanding of his behavior.
Mm-hmm. Okay, so there's a credit product that helps the shopkeeper stock more inventory and sell more, make more money. Helps you because you have to make fewer trips. You just stock your trucks more. And then the wallet product helps them increase their revenue sources. And it can be offered as an overdraft to the wallet that already exists. But Bilal, I'm going to push you a little bit here. Why are you better placed to offer this wallet than, say, a Fowry, which runs this business as their bread and butter, right? Why are you this company as opposed to them?
Sure. So why do merchants actually went to these other bill aggregators in the first place? It's because they again increased the revenue and they improved their working capital cycle. Before these companies were in the market, every one of these suppliers had to buy multiple domination of scratch card from every single operator. So you can walk into his store and he's out of stock on that specific dominator of that specific scratch card, while he still have $1,000 worth of inventory and still cannot fulfill the sale, right? What these guys offered this merchant is to a very optimized way for running his working capital for his working capital cycle. All what he has to do is to charge this wallet with e-money and then change it on demand to whatever the consumer wants in the store. Now that we offer inventory as well, and we have a wallet built on top of that, our merchants can just charge one wallet and use that same wallet to buy for inventory or offer bill payments and top-up services for their merchant as well. So in essence, and this is what differentiates this product, is that it makes it a very unique product because it's the only product in the market that allows the merchant to use a single wallet to pay for all the inventory and services that he needs to buy.
Right. It helps that you offer one of the main use cases of the wallet, right? Which a pure play wallet provider doesn't. The biggest one. Okay. All right.
Exactly.
Jimmy, I'm going to turn to you. As a B2C app, you are also looking to integrate financial services onto your platform. It's quite different. Can you walk us through how you're thinking about fintech on Propel?
Yeah, so we've got a relationship with 4 million Americans now who use our app at least once a month to manage their food stamp benefits. The direction that we're headed is to kind of evolve the platform to help that same consumer to manage her entire financial life. That means managing her cash. It means eventually managing her credit and a variety of other financial assets that person might have. Along the way, what's going to be really different about us is that we are squarely focused on Americans who make under $40,000 per year. We believe that that consumer has a specific set of financial characteristics that make them underserved by a lot of the existing financial institutions and also by a lot of the fintechs at play who are really serving a consumer that's an income tier or two higher than that. And so really, as we think about building out the holistic financial management tool for people who are low income in the United States, we think that has a bunch of specific characteristics. Our advantage why we are doing that is because we are starting with the installed base of 4 million people that are already regular customers of our app and looking to kind of layer on services where each one is value add that helps the consumer to manage a different part of their financial life.
Okay. And how do you think about when to start adding fintech to the platform? Because a bunch of our listeners today are going to be either platforms looking to integrate fintech onto their platform or fintech companies. And this question of when does a platform that is at its core a non-financial platform start to think about adding fintech? That's key, right? Do you worry about how did you make that decision, and did you worry about distraction or spreading out too thin?
Yeah, I mean, I would first modify that statement. I think we have always been a financial services platform and that our users think about us in terms of how to manage their financial resources. Now, we did not do kind of traditional financial services things in that we were not actually managing the transaction, like we weren't touching the actual funds. And so in that way, we've had to kind of mature as a financial services business as we've gotten to actually become the deposit taking organization behind the product. I mean, to answer your question directly, though, I think for us, the answer was sort of clear signs of product market fit when it came to our first product. So, when we decided to build sort of the next evolution on top of the platform, we wanted to be pretty confident that we understood the unit economics of our core platform, that we had taken a big chunk of the market when it came to our core platform, that platform was growing and had core technology that was stable and predictable, and that we sort of understood all those things really well. Frankly, that took us probably 5 years, so it was not a fast kind of turnaround for us. But at that stage, we found ourselves very naturally asking the question of what's going to come next, right? We are helping people, we're with this company that has this social mission to help people who are low income in the United States to improve their financial health. That's such a big mission. Poverty in the United States is such a huge, complex problem. Building a single app that helps people check their food stamp balance is nice, but is that really able to have a meaningful impact on the mission? We know that that's not the extent of it, right? And so for us, it's very natural to think about when's the right time to confidently take our next step.
Thank you, Jimmy. Afif, what's your point of view on this question of, I know that ShopUp also offers credit to its retailers. What's your take on this question of when to start thinking about integrating fintech onto the platform when you're managing so many other things in your startup with stretched resources?
Sure. I think it's a very good question. So we do offer like a tailored kind of model for retailers. So after 12 orders, they get access to this mini credit line, so they can take part on credit based on what kind of products they're taking. When you look at what Bilal's credit card is, they have like 3 days, 7 day, 15 days, 30 or 60 days, right? Now, so the point of view that we took is if you're building a product in an emerging market, quite often focus ends up being like a double-edged sword, because you have to look left and right because things are not built down to you, right? So quite often you'll have to build things yourself. So initially we wanted to build a very niche product because a pure platform, like a software platform, and we decided like everything else would be done by everyone else. Like logistics would be done by someone else. Like credit would be done by someone else. We still wanted to check all the boxes of the iron triangle, but we wanted to have like other things to that. But as I mentioned, in emerging markets, like all of these building blocks are not being built quite often. So we had to take that bold step that, okay, why don't we basically start building these two other pillars that are very core to our thesis. All these three are part of the flywheel that we definitely need to ensure the overall growth happens, right? So for example, right now we are the market leader in last mile business in Bangladesh. In credit as well, so we have started building it ourselves as well. Our point of view is, I think it's better to start early compared to later. Instead of being a future monetization like option. If you start early, it becomes part of the DNA of the product. If you start thinking that, okay, instead of having credit as a monetization tool, can it actually be an acquisition tool, which basically is part of the flywheel? So more credit means more procurement means less logistics cost, and so on. So that's the position we have to. So here we are. So
Nafif, how do you think about what parts of this credit product you are building versus partnering with others?
Yeah, so I think we are very clear on that front. So we are a distribution platform, right? So we are not. So we partner with all the FIs in the market, the microfinance institutions, all the banks in the market. So they are the experts in raising capital, managing balance sheet. We basically are building a product that's very core to the retailer itself. So we play as a distribution platform and basically partner with these major players to their efficient channel to these persons.
Okay. Bilal, on this build versus buy question, are you thinking in a similar way that Afif is? Or is your point of view different?
No, so the decision is always to buy or partner if there is a reliable party that is able to give you what you want. Just makes more sense, right? But as Afif mentioned as well, in our parts of the world, it's very hard to find these reliable partners that are willing to give you what you actually need. So you're gonna have to tend to do it yourself. It's not because we want to do it; it's because we have to do it. Similar in why we built our entire operations in-house. A big part of why we're influencing our fintech product big time is that we want a very seamless experience that doesn't have to go using the typical KYC and underwriting process that the banks would want. And that's why they haven't been able to offer such a service as an example to these merchants. And that's where we step in and do parts of the job ourselves so that we can offer the seamless, reliable experience that our merchants deserve.
Okay. Folks, so I'm going to ask you to crystal ball gaze a little bit. And Bilal, while I'm with you, let's start with Egypt. Do you think for specific customer segments and for some products, customers will access finance through non-financial platforms or what used to be non-financial platforms, or is it going to be through banks? Right? Is it going to be more through embedded finance platforms or more through pure play fintechs? What's your sense?
Definitely not through banks. This I can tell you that for sure. Even if I don't, I can tell you not that proud. It's just that the infrastructure of banks is not built to reach these guys, such as also why the Walmarts and the Krogers of Egypt are not the ones selling the groceries. It's just the country is built with a specific inventory infrastructure and thus financial infrastructure as well that is very different than other parts of the world. So yeah, the answer is definitely through our platform. Eventually we want similar platforms, any types of fintech that actually captures a specific niche and builds a product that is seamless enough and have a reasonable cost structure so that they can scale to these masses, which I believe that the B2B e-commerce as a business at large have this in place.
Okay. Jimmy, what's your take on this one?
I think verticalized finance in the United States is here to stay. I think financial services is like one of the most profitable sectors of the American economy. And historically, that's been concentrated in these big financial institutions that serve tens of millions of customers, most of which don't really love their banks and most of which don't have a great time. And so I think as embedded finance and the tools, which we haven't talked too much about, but you know, the revolution is fueled by the fact that there are far more tools on the technology side that make it easier to embed finance without having to become a bank yourself or without having to go through the entire regulated process. That enables a lot of companies that do have a trusted relationship to a particular consumer or a deep understanding of a particular consumer to build the kind of services that historically were bundled and distributed through banks. So I think that's exciting because it's going to end up being a positive thing. People are going to have the ability to complete the transactions that they need to complete in a more seamless way.
Okay. Afif, do you want to take a contrarian view? I'm waiting for you to say, no, it's going to be banks and fintechs. Come on.
Yeah,
unfortunately,
I actually hold the same view. So if you look at like other industries, like previously, manufacturers actually used to own distribution as well. Even if you look at content, large newspapers actually used to own content and also distribution. But that has changed, right? So all these manufacturers are selling to platforms like Amazon. Content is reaching the customers through different distribution channels, right? So for finances, I think the same thing will happen. Banks will play the manufacturer role, if you take an analogy from that. And we'll see like very interesting new companies with different form factors who will play the distribution role. So very excited about the future.
Okay, so a unanimous vote for more embedded finance, which is not surprising in an embedded finance panel. Well, panelists, thank you so much for this great conversation and thank you for taking out the time to join us today. And to those of you who've been listening to us, thank you very much. If you have any questions, please email us at events@flourishventures.com. And please don't forget to tune in for the remaining 2 parts of this embedded finance series, where we're going to be talking about fintechs that plug into embedded finance platforms and the financial infrastructure firms that provide the plumbing to make all of this possible. Again, thank you very much.